what we've seen for the first time, I think, in 2025 is that Bitcoin's realized volatility has even declined below that of major equity indices, right? Like the Max 7, the Nasdaq 100 or S&P 500. It's now on par and has even declined below that during this kind of Liberation Day market crash, right? And that's, I think, a first timer, right, for Bitcoin. But my expectation is based on further institutional adoption and adoption in general, right? That Bitcoin's volatility will continue to go down even further, right? And it will eventually transition from a kind of risky asset, right, to a safe haven asset over time, to really reserve asset over time. And the reason why that, the reason for this development will be, adoption tends to dampen volatility, right?
Welcome to the 31st episode of the Store of Bitcoin podcast. Today we are thrilled to welcome Dr. Andrè Dragosch to the show. Andrè serves as Head of Research Europe at Bitwise, with over a decade of experience in the German financial industry, specializing in portfolio management and investment research. He earned his PhD in financial history from the University of Southampton and has been active as a private crypto asset investor since 2014, beginning his institutional crypto research work in 2018. Welcome again. Welcome, Andrè, the podcast.
Thank you so much. Yeah, thank you for the invitation and happy to be here. Thank you.
Welcome also to Francesco and Johan, the other co-host. How are you doing?
Hi. It's talking to start talking about Bitcoin and
Yes,
why not?
Today,
Always a good day.
so 11 of August, we saw Bitcoin above 120K, so already good start of the week, and now we have the podcast. We could start with the topic on how has been going in Bitwise in 2025, Andrè, and which is the status of in general of institutional involvement in Bitcoin.
So yes, it's a very good start for Bitwise. 2025 is probably a kind of chapter where we're entering the mainstream era, right? So Bitwise has grown to new all-time highs in terms of assets under management, right? So we manage around 12 billion in dollars in assets under management worldwide, right? We have offices in North America, US, and also Europe. And I think there are already 120 people working for Bitwise globally, which is quite big, right? It's still a small company, but it's growing. We're also growing in Europe, and we have around, I think, 30 products we're covering. We've launched a Bitcoin treasury companies ETF in the US as well. We've launched several products in Europe. We have in my opinion, the highest quality Bitcoin ETP on the market, also with the lowest fees. So it's working very good. It's going very good for Bitwise in Europe, and yeah.
Good to hear. And how do you see the institutional involvement? They are more and more interested in Bitcoin, and in which percentage now they are talking institutional investor?
I mean, there are data and there's anecdotal evidence, right?
Okay,
so in terms of data in Europe, we don't have so much coverage, to be honest, right? You can look at things like Bitcoin, Bloomberg holdings, right? For those who report, you can see the holdings of ETPs, right? You can also check database like Morningstar. I think what's a better source of information in terms of like what's the percentage of institutional holdings is the US data, right? The 13F filings. And I think institutional holdings increased massively between Q1 and Q2 this year, right? We had around 25% in institutional holdings or non-retail holdings in Q1. And that number has increased to around, I think, 30% right now, right? So based on the 13F filings, we're seeing an increasing percentage of institutions. And I think one of the key reasons was, and we can also see it in other types of data, was that I think many retail investors, they were scared out of Bitcoin during this kind of Liberation Day market correction, right? In April, Q2, right? In Q2 happened this kind of cross asset capitulation across all kinds of assets, right? Not only Bitcoin, but also equity markets almost everywhere, right? And what we've seen during this kind of capitulation, you saw an increasing demand or continuous demand from institutions. So Bitcoin treasury companies, right? So public companies, Bitcoin ETPs on the other hand, right? On the one hand, on the other hand, you saw distributions by retail investors and also private companies, right? Like BitMEX and others. I think the Mt. Gox trustee, they also distributed Bitcoins during this kind of market phase. But yeah, it's actually a sad story, but it happens probably all the time. So retail investors essentially capitulated. Institutional investors scooped up all these Bitcoins during this kind of market panic. And that's why you're seeing this kind of further increase in institutional ownership, right? Yeah.
Yes, thanks. We see also good data for institutional, and I think also institutional scooping this Bitcoin that generally from retails are capitulating while there is issue in the world of macro issue is also decreasing the volatility, and maybe it's also preventing Bitcoin to go down. For example, we have seen Bitcoin go to 123, and now it goes short. It went shortly to 112, but it didn't go so much lower. And now it's holding 118, 120. One reason could be institutional adoption, and likely, what do you think, volatility will be decreasing in the future as we are seeing now?
Absolutely. So, I mean, what we've seen so far is that volatility has been on a downtrend, right? Bitcoin's volatility since inception has been on a downtrend. I mean, Bitcoin's realized volatility used to be around 200%, right? Annualized volatility in 2012. We're now talking about sub 50% realized volatility. So volatility has actually declined by 75%, right? So it's only a quarter of the level it has been like more than 10, 15 years ago. So that has been on a structural downtrend. What we've seen for the first time, I think, in 2025 is that Bitcoin's realized volatility has even declined below that of major equity indices, right? Like the Max 7, the Nasdaq 100, or S&P 500. It's now on par and has even declined below that during this kind of Liberation Day market crash, right? And that's, I think, a first timer, right, for Bitcoin. But my expectation is based on further institutional adoption and adoption in general, right? That Bitcoin's volatility will continue to go down even further, right? And it will eventually transition from a kind of risky asset, right, to a safe haven asset over time, to really reserve asset over time. And the reason why that, the reason for this development will be, adoption tends to dampen volatility, right?
Yes.
And the reason why that is the more heterogeneous your investors are, the less volatile your asset, because there will be more disagreement. It sounds like counterintuitive, but think about the following situation. So, for instance, you have a day trader. He trades on certain technical indicators, right? RSI and all the like trends, moving averages, and so on. And during the day, he might decide, okay, I'm selling because like my short-term RSI has been hit. It's like overheated in the short term, right? He's selling. An institutional investor with a very different kind of information set, right? Like different time horizon, different kind of information set. You might think like, oh, the price is dipping, right? Looks like a good entry point, right? So there's disagreement, but what happens between those two parties, the seller and the buyer, is like they dampen volatility because suddenly for the seller there's a buyer, right? Because they are in disagreement and they're heterogeneous, right? If everyone is a day trader, right, and it's more homogeneous, everyone trades on the same kind of information, the same kind of RSIs, the same kind of moving averages, right? Then the market actually becomes more volatile, right? Because at any given point in time, there might be more agreement, right? Okay, now the RSI is too hot, we're selling, right? Bam. And then you get these kind of price spikes. In fact, you tend to get crashes when like the pension fund that usually has like a long-term time horizon becomes more like a day trader
Oh,
that trades more on short-term information because there's so much uncertainty. Like increasing uncertainty usually creates this phenomenon that you get these crashes because everyone becomes short-termish in nature. But as soon as you get like more adoption, like different types of investors, Bitcoin treasury companies, whatever, like pension funds and so on, right? I mean, the 401k executive order is really, really big. And we can talk about the implications as well, because you have suddenly a huge kind of capital pool that's very long-termish, right? That's only structurally adding that's essentially stacking sats all the time, every month, right? So you have like these continuous inflows with not much selling, because like I think the standard duration, the average duration of these kind of 401k plans is like 10-year, 20-year plus, right? Without much selling. So I think it's really a big news for Bitcoin, and also like this institutional adoption story. And yeah, as I've said, I think it will definitely make the case even stronger for like declining volatility and Bitcoin becoming like more of a store of value over time.
great, thanks. Actually, one of my question was exactly on this 400 for 1K, because you wrote a post that it may be even bigger of than the Bitcoin ETFs approval.
Yes, bigger, because like just in terms of size, it's so much bigger, right? It's like even 20% bigger than the whole US ETF market. That means like I'm not talking about like spot Bitcoin ETFs. I'm talking about like all kinds of ETFs, like
Mm.
equity ETFs, bond ETFs, other ETFs. So that number is around 10 trillion for all ETFs. But like the amount of assets in 401k plans and other defined contribution retirement plans is 12.2 trillion. I've just seen the latest number from the ICI that publishes these kind of data. So it's 20% bigger than the total ETF market, right? And we've just did some like back of the envelope calculations. So if you assume that only 1% of this 12.2 trillion of these assets, right, will be reallocated to Bitcoin ETFs. By the way, they tend to invest via ETFs, right? That's
Yeah.
why I think it's reasonable to assume that the bulk of this new capital of these 401ks and other retirement plans will actually flow into Bitcoin ETF, other crypto ETFs, right? And so if you just assume 1% of this 12.2 trillion, which is around $122 billion right now, it's essentially 63% of total spot Bitcoin ETF AUM, which is around 100, global AUM, not only US spot Bitcoin, global Bitcoin ETP assets, which is
Okay.
around 191 billion right now. So 63%. And what we've done in the past was we analyzed actually how much how much does a 1 percentage point in flows in weekly Bitcoin ETP flows actually affect Bitcoin's performance, right? What's the sensitivity? And it's around 1 to 1 on average, right? It has been increasing lately. So this is actually a conservative estimate. So you can assume like a 1 percentage point reallocation from 401ks and other retirement plans, 122 billion, is going to lead to around 63% in price rise in Bitcoin, right? Which
Okay.
is insane, you know. And this is just 1%, right? And it's actually for me personally actually a lower bound estimate, because as I've mentioned, like the sensitivity has been rising and tends to be quite cyclical. Sometimes it's like at 10, right? It's a factor of 10 in terms of flows. So I think the impact could be quite significant. And like how much of this money, of these 12.5 trillion, will eventually be invested? We don't know, right? But for instance, Bitwise has done a survey among financial advisors in the US, and they tend to invest around 1 to 5%, right? And they also tend to recommend the allocations, for instance, in 401k plans, right? And so you end up probably most likely with an allocation between 1 and 5%. Now multiply like let's say 2.5% with 12.2 trillion. It's a ridiculously high number, right?
600 billion would be.
Yeah, so I think the impact could be very significant. That being said, of course, we know also from the same survey that only 22%, so only every fifth advisor, is currently investing into crypto asset ETFs, but that number is certainly going to go up, right, in the future with more adoption, right?
Yeah, I heard or I read James Check also researching on that multiplier, like how much will the market price rise with each dollar flowing in? And online on Twitter, you have those myths that the multiplier is 118, and he said, no, guys, it's way less. It's at a maximum $4 on every $1 flowing in, but I think eventually it goes to one, and or even below if we're really overheated. But
yeah, I think like the if you're looking at on chain, what he's probably referring to is the MVRV ratio, right, which is around 2.3. That's like the current ratio of market value to realized value of invested capital. So I have like on average across like the whole capital that was ever invested into Bitcoin, a multiple of 2.3, right?
yeah,
So 2.3 times. So that's like the average. I mean, if you assume such an average, like this performance will be even higher that I've just mentioned, right? That will be 120%.
double than you.
Double, right?
It's crazy.
But so I'd say 63% is a very conservative estimate, right? And I think this kind of a very small allocation from 401ks alone could take us towards 200k, right? And I think I've seen a post by like you do probably if you're on Twitter frequently, you're seeing these Grok replies, right? And like somebody asked on Twitter, like asked Grok directly, like, what's the effect, the price effect of this kind of 401k use on Bitcoin? And Grok replied like 175k, right? By the end of 2025.
Okay.
But if you assume like, okay, if you assume this to be true, which I think is probably true, right? It's not like to the dollar true, but like I think in terms of direction, it's true. And if you add like the possibility of rate cuts by the Fed, right, which is around I think above 80% probability right now, between 80 and 90% in September, right? I think the case for 200k dollars per Bitcoin by the end of the year is very realistic in my view.
Yeah. I want to circle back later on that Fed expectations. First, I want to go into your book. You wrote a book, Exponential Gold. I had the pleasure to meet you in Prague during the conference. And I went through your book, and I think the first chapter of Understanding Money is the most relevant for our audience. I wanted to ask you why you cited the research of Richard Werner a lot to explain, to understand money and how it's created.
I think it's very much relevant because what many Bitcoiners report when like falling through the rabbit hole is like they say like they had to unlearn so much university lessons, right? So many university lessons because like in my opinion, mainstream economics taught at universities is somewhat misguided and unrealistic, right? It doesn't really apply to reality. it doesn't even factor in banks and money, right? Many economic models, it sounds ridiculous, but like that's the reality at universities, at least like the theoretical frameworks taught at universities. And so Richard Werner, I mean, he's an unorthodox economist, but I think what he revealed in the economics profession is this kind of flaw, right? And I think his empirical research is so much more valuable, right, than mainstream economics, because he hasn't only developed this kind of credit theory of money, right, but he's also shown it empirically that it works in reality, right? So, um, like mainstream economics that is taught at mainstream universities, like neoclassical economics, assumes banks to be intermediaries, right? And they just like transfer money from savers to borrowers, right? So there's no money creation involved. Banks are just financial intermediaries. That's like the model taught at school, at universities, right? But like what he has shown empirically, and what's the credit theory of money is also about, is banks are important. Banks are special because I'm not talking about the central bank. I'm talking about like commercial banks, right? Commercial banks, they are actually the creators of the money supply. And the way they do this is by the extension of loans, bank loans, right? For real estate, for consumption, and so on. And what he has shown empirically, and it's one of the most downloaded, I think it's the most downloaded paper on JSTOR, right? Which is kind of insane, economics paper. And what he has shown in 2014, he went to a local bank in Germany and he looked into their books, right? How the whole money creation process works. And in fact, they didn't need to have any kind of deposit before, like he took out a loan. They actually credit his bank account and that's it. They just created money that, like the economists say, ex nihilo. They just created money out of nothing.
Yeah.
Because it's just an electronic book entry, right?
Yeah.
There's no energy involved, right? It's, yeah. And because there's no energy involved, money is not scarce, right? Unlike Bitcoin, where you need energy, right? You need energy to produce it. You can't just like push control and print, right? P, and then all of a sudden you have like more money creation. You need energy, right? You need to do proof of work and so on to create Bitcoins, which is why it's scarce, right? And yeah, and I think that's a valuable lesson in there, and that's why I actually like many other Bitcoin books, to be honest, like, but the whole book actually starts with a chapter on what is money.
Yeah.
And like, you've probably seen the quote by Robert Breedlove. I mean, what is money is probably really the most defining question of our century, right? Because it's still so much misunderstood. There's so many misconceptions, right?
Yeah, and then when I talk to other people, if I try to explain Bitcoin, you really need you really need first to ask them if they understand money and ask them if they know how it works. And if they don't know what money is, you cannot properly explain Bitcoin because it won't click because they
Yes.
don't see the problem.
Because
Yeah.
like the utility of Bitcoin is not so obvious for someone who doesn't understand the monetary system. Like
Yeah.
if you understand the monetary system, because like many people, they think like, why do I need Bitcoin? I mean, I can already send money over the internet, right? Why do you need like Bitcoin in the internet to send money? I have PayPal, right? I have my instant SEPA transfers. Why do I need Bitcoin?
Yeah.
But it's like, it's not only the means of exchange property of Bitcoin that makes Bitcoin valuable. It's like the unconfiscatable means of exchange property, immutable means of exchange property, plus like in combination with the store of value characteristic like gold that makes Bitcoin an innovation and that makes Bitcoin valuable. But many people think like, I don't need, why do I need like only 21 million? I don't understand this, right? Like, why does it need to be scarce, right? because they don't understand, like, even they don't even understand inflation, right? They think like, inflation is, prices going up in the supermarket because like corporations are too greedy or something. But in fact, I mean, like, if you listen to lectures by Milton Friedman, I mean, inflation is always and everywhere a monetary phenomenon, right? It's just monetary debasement, always has been, right? It's
Yeah.
just the value of your money is going down, right? Your purchasing power is going down. That's inflation, right? And
Yeah.
so if you don't understand this, you need longer to understand the utility of Bitcoin, right?
Yeah.
Actually, also the point you said, they don't even say why we need 21 million, but they say that it's detrimental for society because deflation is bad. Deflation, if we live in
Yes,
deflationary world, no one is buying anything more, and this we will stop, we will crash, and the world is going to the end.
yes,
Completely
and and
true.
the tragedy is like universities and even like high-ranking research papers actually promote this kind of, I'd say scam,
Yeah,
because
yes.
it's not true. Say like, the central bank has to target 2% consumer price inflation rate because it's like optimal for the economy, which is somewhat of a scam because and we like they've perpetuated this kind of narrative and this kind of theory, like economic theory, which is why many people think like inflation is normal, right? We need to have inflation because, like, if we have deflation, then producers won't produce, right, and all that stuff. Right.
For
And
my, I have Francesco.
no, just a question on this point, given the expertise on gold and the history of money, also the PhD. So do you think that people, so first of all, gold, where do you position it in the modern market history? As do you think is a tool which should be understood first before transitioning to Bitcoin? Because I was a bit surprised that, for instance, last month the market went up, but the gold didn't go down anymore. So in the last years, looks like the inverse correlation you could see by the stock market versus gold is not happening anymore that much. They're all absorbing liquidity. So, but
Mm-hmm.
now in the last months, I can see that gold leveled off. As opposed to a stock market went down, but it didn't go down. So maybe somebody is understanding the power of scarcity at these pension funds, and is the voice we are putting out a bit louder and louder in a way that the inflation is given by oversupply of money? Is this argument is reaching the investors, and therefore they're taking shelter into gold? Or what do you think about it?
So my view on gold is the following. So gold is essentially the store of value pre 1971, right? When we had the gold standard, obviously that like gold was the dominant store of value, right? And then after 1971, U.S. Treasuries in the fiat standard became like the store of value, right? During the fiat standard, and now we're in this kind of transition period where like fiscal debt of the US has increased so much that like the store value characteristic and like the counterparty risk and credit risk of US treasuries are increasingly being questioned. But also, I'd say even mostly because of geopolitical reasons, right? And I think it really started in 2022 when the US actually confiscated US Russian foreign assets because of Ukraine. When they did this, what we've been observing since then is that you had a huge breakdown in all kinds of correlations, intermarket correlations with US Treasury assets, like US Treasury yields. For instance, US Treasury yields, they used to be very much correlated with the copper gold ratio, right? Because like the copper gold ratio tends to move with like global economic momentum, right? It tends to be a high frequency indicator for like global growth. And what copper gold did, because we had like a global slowdown since 2022, right? Because of various factors, because of Fed tightening, because of like China slowdown and so on. It was like the copper gold ratio was declining, but the US Treasury yield kept going up, like, and still at around 4%, right? Copper gold ratio kept declining. Other kinds of breakdowns that we've seen since then is the the Chinese 10-year yield was around 3% at that time. It halved to 1.5% during that time period since 2022. The US Treasury yield continued going up, still at like around 4 to 4.5%. It used to be very much correlated with the Chinese yield, but decoupled. And probably the biggest decoupling is between like US real yields and gold. Like if you ask like a commodities trader, like a gold trader, like one of the key variables he's been looking at was at least in the past was like US TIPS yields, Treasury inflation protected securities yields, like the real yield of US government bonds. There was an inverse correlation. So when real yields went up, gold went down, and vice versa, right? But after 2022, what happened was like real yields went up, but the gold price kept skyrocketing regardless, right? It didn't care. And so what we found out was actually there's like around a $2,000 premium in the price of gold based on the US real yield that you can't explain with the real yield anymore. It has completely decoupled, right? And like my fundamental thesis is, so you're in this transition period away from the US Treasury as a like the post 1971 store value, right? And towards like the old store value gold and new store value Bitcoin. And I don't think it's like a competition between gold and Bitcoin yet. It's more like they're both like the hardest assets on the planet, right? Bitcoin's obviously the harder asset than gold and also more valuable and has more utility. But at the same time, what you're seeing is gold's still attracting more flows right now because like the old store value. But Bitcoin's also catching a bit even from US treasuries. And we have like reason to believe that central banks are already moving away from US treasuries to Bitcoin, because we had one inquiry in the US, like my US colleagues, they received an inquiry by a Latin American central bank. They explicitly said, look, we have US treasury bonds. We want to sell them and buy Bitcoin. We want to buy Bitcoin ETFs from Bitwise, right? And that's why we did a DDQ with them and so on. And this was not the only central bank. We had several inquiries by different central banks all around the world that want to do a similar kind of trade, right? Away from like main assets like US treasuries into Bitcoin. But that particular central bank even said, like, I want to go away. Like, I want to divest some of my US treasury bonds, diversify into Bitcoin. And like, why are they actually doing this? It sounds like a ridiculous idea. If you speak to a fixed income investor, they will say, like, they will look at you, laugh at you, and walk away, right? Oh, sell my US treasuries to buy Bitcoin, right? But if you look at the data, like it's so fascinating because Bitcoin's not even less correlated to US treasuries than gold is. So it has higher diversification. It's even more, it's now negative. There's like an all-time low in correlation between Bitcoin and US treasuries, which also implies that investors are selling treasuries to buy Bitcoin. But this is just a side story. So it is the best. It's less correlated than gold, but it's also a better downside hedge. What we found out was gold tends to be a better equity hedge than gold, right? When the S&P 500 goes down, gold tends to perform a bit better than Bitcoin, right? But in the case where US Treasury bonds are going down, Bitcoin performs better than gold as a hedge in down days. And that's what we call the Bitcoin bond conundrum. So it's actually somewhat counterintuitive, but what's so funny and also quite remarkable is actually if you add Bitcoin to a pure fixed income portfolio, then it actually reduces volatility. Like nobody thinks like, why does like a more volatile asset reduce your fixed income volatility, which tends to be less volatile, right? But it makes sense because like Bitcoin has been, a better hedge, right, for fixed income risks. And and I think like we're still early in this kind of understanding, especially by fixed income investors. And I probably will take a couple of years, maybe even a decade, before like fixed income investors will come around to this kind of idea that you can actually use Bitcoin, an alternative asset, as a hedge, right? yeah, it's really fascinating.
Yes, so we have the narrative of inflationary system is being a bit called out, if they are transitioning to gold, into Bitcoin. It's like a part of the financial system starting to going back to the old one, like you
Yes.
explained. It's very good. So we are starting to win a bit, even
Yes,
if
we're starting to win, in my view. And I think what's very remarkable, I don't know whether you've seen this kind of correlation chart, but like, yeah, I've just mentioned it. Like, Bitcoin has been more inversely correlated to US Treasury bonds than gold. And it's like a structural shift. And it happened during this kind of Liberation Day uncertainty in April as well. Because what we've seen was not only the stock market crash, what we've seen is like swap spread in US Treasuries, so credit risks have gone up on US Treasury bonds. So investors are asking more, like more return to hold US Treasury bonds because of increasing credit risks. That's what we've also seen, and think that's also providing some kind of tailwind for Bitcoin and other hard assets.
One comment on this: more than we are starting to win, I think Bitcoin has already won, and the world is starting to recognize it.
Yeah, it's like the best analogy that I've heard is like you have a lottery ticket where you have the
Yes.
right number, where you know you have the right numbers, right? You just need to wait until the numbers come in. It feels
Or
like
you have,
this, right?
or when you play poker, I heard a similar. When you play poker, you have the full scale, and you know already that you won, and you're just waiting
Yes,
him to finish.
yes, exactly. Uh,
yes. But
I think we're winning.
in this scenario, I mean, if the private investors or institutional investors they're transitioning to the real system, the deflationary system, that's good for the investor for them. But then the last obstacle are the central bank, because the financial system tied to the government is still controlled by them. So you've seen those minor Latin American countries, central bank coming to firm, and that's very good. But still, I think if we bring this to the extreme and the West, like the US, then we're gonna have a problem. And the problem, we don't know how it unfolds, but for sure they have a lot to lose by changing this system. Cannot. Well, we don't know what happens. There are many theories. I don't want to get into conspiracy theories, but there are many ways how we can reset these things. And war is one of that. And we see, but for sure is a start, and it has to be like this. It will just accelerate. We all know. It's still a bigger question mark how the government and the central bank from the NATO countries we react to this shift when really it's the interest. We find out.
Just a few seconds to remind to our listeners that this podcast is sponsored by Bitvault. Bitvault.sv. I invite you to head over to a site. It's the first Bitcoin wallet solution to solve the problems of physical attacks and hacks, thanks to our time delay over multi-sig technology. The beta is for free, coming out in October. I invite you to head over to a site and leave your email to get notified. Thank you very much.
So, Andrè, your now former colleague Jeff Park, who went with Anthony Pompliano, he was also talking about this radical portfolio ID and with strategy with MSTR and like the preferred stocks like Strike or Strive. And he already thought about like balancing out, make this new 60/40 portfolio with MSTR, which is the Bitcoin equivalent, and the fixed income products like the preferreds. And is that what you call the Bitcoin bond conundrum? What you talked about, that those those make each other stronger, so you get a more resilient portfolio because of those inverse correlations.
I think he's right. I mean, the 60/40 is dead, right? And the reason why that is, I mean, if you look at the data, the moment you go towards, or you transition towards a kind of high inflation regime with like CPI inflation rates above 5%, what happens is like both your real returns of both your stock position and your bond position is negative. So you don't perform in like a high inflation regime. So what you have to do is diversify, right? You have to diversify into hard assets, right? And what's the hardest asset on the planet is probably Bitcoin, right? And gold and others. I'd say, I mean, Stretch and like these novel products created by a strategy. I mean, they're like obviously fixed income products or fixed income like products. They're actually preferred equities, right? So hybrid instruments, but I mean, they're over collateralized with Bitcoin, which is why they're somewhat a kind of fixed income safe as bet than equity, and they are like higher in the capital structure. But I'd say it's the era we're moving into is not so much like, I mean, you could do like Bitcoin only and Bitcoin proxies like Stretch and like strategy preferred equities, strategy equities, and so on, right? That's one way to play this, right? But like, I think it's unrealistic, like in the very short term. Like, what's more realistic is you have like 60-40 portfolio investors, right? And they're reallocating from most likely their equity position because they think like Bitcoin is a risky asset, right? It's a volatile asset, which is why they're taking probably some kind of percentages from their risky equity portfolio and reallocating towards Bitcoin. I think that's like what's happening right now. We're very far away from this scenario where like you have investors that say like, oh, my 60-40 is dead because we're moving towards like a high inflation regime, right? I need to like sell everything and buy like Bitcoin strategy preferred, stretch and all that stuff, right? But like what we're seeing like realistically right now is like, yeah, many investors are rethinking this traditional portfolio because what also happens when you move towards a high inflation regime is the correlation between stocks and bonds is not negative anymore. So you don't have diversification between those two. It actually becomes positive, right? Because yields go up and equities go down, right? When like you have an increase in inflation, right? So there's no like diversification between stocks and bonds. So you have a correlation breakdown and you have like negative real returns. And so there's definitely incentive to move away from this kind of portfolio, right? And add hard assets, which can actually shield you from high inflation, right?
Yeah. So I heard you already talking about Stretch. I want to ask you about it. I was listening to the earnings call. I was in an Italian campsite on vacation, and I was midnight listening to the earnings call. I think I looked around and nobody was listening to the earnings call from a strategy. But Saylor called it this the iPhone moment for strategy. And what do you think about? Because I'm also writing for the Bitcoin layer, and we are monitoring the money market funds, and they're now at $7 trillion. Think and Stretch would be perfect instrument to be a competitor, but that would be, even if we talk about 1% from money market funds flowing into Stretch, with Saylor buying Bitcoin on the other side. What do you think about those implications?
I think like what Saylor's doing is a genius. I mean, he's a genius in terms of like financial engineering, not only in terms of financial engineering, but like the way he looks at strategy and also others is like it's not so much a levered Bitcoin play. It's more like it's like a collateralized Bitcoin play, right? He's collateralizing Bitcoins in all kinds of ways, repackaging it, and trying to create products for every kind of niche, right? And what he's actually exploiting is that within these niches, right? For instance, in hybrid products, investors that invest in preferreds, which is somewhat exotic, right? Within these niches of investors, they're actually craving for yield, they're actually craving for outperformance, right? Like, who's the biggest investor of, or who was the biggest investor of strategy convertible bonds? You wouldn't
Allianz?
think it's like, yeah, Allianz Global Investors, because like, oh, here's something that's relatively safe because it's over collateralized, right, and so on. It definitely has exposure to Bitcoin. It's something that's not exposed to like macro risks so much, right? Recession risks or anything. It's probably more tilted towards like monetary policy, inflation, monetary debasement, and it's definitely something where I can beat my benchmark, right? They have like an exotic kind of benchmark, convertible bond benchmark, and probably those who did invest in like strategy convertible bonds, right? They did very well, right?
They
They
outperformed
outperformed
Bitcoin.
them. Yes,
Yeah, yeah.
they
What's
outperformed
crazy?
massively, right?
Yeah.
And I think like strategy and Michael Saylor, he's catering to these kind of investors that are very niche, also with Stretch and other products like hybrid preferreds. They're somewhat fixed income because they paid this kind of fixed dividend, right? Unlike normal equity shares, common shares, they don't pay fixed dividend, right? But they're like fixed income like, and they cater to this kind of niche. And there's probably lots of demands, and we've seen lots of demand, close to 2.5 billion that he raised with Stretch, right? And what's also good, and I think the market's actually, it's not like it's not seeing this, but there's not so much emphasis on this, which is, I mean, he's not diluting common shareholders, right? He's not raising common equity. He's actually raising Bitcoin per share. So Bitcoin yields going up. And the way he does this, obviously, he's using preferreds, which are not part of common equity, to increase funds and buy Bitcoin, right?
Yeah,
So
and
it doesn't end up like in the common equity capital structure, which is also genius, right? Because like the market, for the worse or better, right, it actually focuses so much on Bitcoin yield and Bitcoin per share, which is, in my view, at least my personal view, is somewhat of a misguided metric, because you can increase your risks, your company risk, your insolvency risks, your bankruptcy risks, on the other hand, while increasing your Bitcoin per share, right? But anyways, that's probably a different kind of topic.
yeah, you also mentioned in the earnings call that they won't sell any common stock anymore when their MNF is below 2.5. So I think their transparency is still improving. I just want to ask you one other question from my side. A lot of things happened last week. Stephen Moran has been appointed as Federal Reserve Governor for the FOMC. I want to hear your thoughts about that and about the revised payroll data and the how the market reacted on that and what the Federal Reserve will do in September.
Yes, so Stephen Moran actually is somewhat of a very dovish pick for one of the FOMC members, because he's been advocating for a structural dollar depreciation, right? And in his view, in his worldview, the dollar is actually a structural liability. So he actually believes in this kind of a Triffid dilemma, right? And he also believes in like Dutch disease, that like the dollar's overvalued because the reserve currency, which actually harms exports and incentivizes imports. So it actually leads to higher deficits and so on. And I mean, that's probably also the correct worldview. What he wants to do is like a concerted kind of devaluation of the dollar, right? Some kind of Plaza Accord. Some people call it Mar-a-Lago Accord, right? But that's his like worldview and how he wants to design like foreign policy. And so it's definitely dovish pick, because it means like dollar depreciation. And what we found out in our research is like what's definitely bullish for Bitcoin is dollar depreciation, right?
Yeah.
because you have the effect that global money supply tends to go up with like a weakening dollar, which is somewhat of a technical aspect, but it also makes sense because from purchasing power parity perspective, like dollar depreciations or FX depreciations in general are actually a signal for money printing, right?
Yeah.
So it means ultimately money printing, and it's totally consistent with the fact that global money supply is going up with the dollar depreciations. So it's a dovish peak, and like apart from this, if you look at dollar valuation models, they also tell you the dollar is structurally overvalued, right? Like in terms of like the historical valuation. And what we've estimated is like apart from Steve Moran or any other guy, like it's quite likely that if you have some kind of mean reversion in this model, that you'll see around 4% depreciation of the dollar over the next 5 years every year, right? And that alone is very bullish. But if you have like guys like Moran that actually support this and actually push this even further, right? It's very dovish. And I think the way the Fed can actually achieve this is with like harsh interest rate cuts, right? So they probably need to be cutting rates faster than the rest of the world, or at least guide like financial markets in terms of forward guidance to like lower yields, which is also very bullish, right?
Yeah, but the 4% depreciation compared to which asset is that? Because the euro is increasing against dollar, but I'm from Europe. I'm from the Netherlands. I don't think Europe is in a very good spot at the moment. So I'm really surprised that the euro is doing so well, because yeah, I even think less of the euro than the dollar, but that's another point. So I don't know how you which asset do you compare
So the dollar model was based on a basket of different developed markets currencies. So it's actually like a G20 basket or G10
yeah, okay.
basket.
Yeah.
So, but talking about like exchange rate movements and how you can explain them. So we built a model for the dollar index, right, which is also like a dollar exchange rate compared to different major currencies like the euro, like the Swiss franc, and so on, and Japanese yen, British pound. And what we found out is you can actually explain most of the variations in the dollar index by just looking at different capital flows, right? So if you look, for instance, at the relative performance of the MSCI US or like S&P 500 as well against like MSCI World X US for like equity capital flows, and at the same time you're looking at interest rate differentials, right? Short term, like 2 year interest rate differentials between the S and like the G10, right? So you can explain like 80-90% of the variation of the dollar, right? The moment you have like US equity market underperformance, right, versus the rest of the world, or you have like a declining yield differential between the US government bonds and the rest of the world, you'll see a decline in the dollar. And we've seen that, right? We've seen some kind of rotation away from like the Max 7 stocks into the, like European defense stocks, right? Because of
Yeah.
Ukraine, like Rheinmetall going through like the roof and so on. So we've seen some kind of capital rotation. And also because like investors think, you have this kind of structural dollar depreciation because of Trump, US foreign policy, and so on, and also a declining yield differential. But what's even more interesting, and that's like the key takeaway from what I've been saying, like, so we've seen like equity market underperformance of the US, we've seen declining yield differential, but it doesn't explain like the most recent move. So in this sense, we've seen a much higher depreciation of the dollar than like relative capital flows in equities and bonds would actually imply. And so we looked at like this kind of residual that we couldn't explain. And this residual, it's quite funny actually. It tends to fluctuate with risk appetite, global risk appetite. And you could call this residual like the safe haven characteristic of the dollar. It tends to go up with the VIX. If the VIX spikes, if uncertainty spikes, it tends to go up and tends to decline again when VIX goes down again, right? But what we've seen is during this kind of Liberation Day uncertainty. And essentially, since Trump has been elected in November 2024, so uncertainty went up, equity market uncertainty went up, but this kind of dollar residual went down, the safe haven characteristic went down. And so our conclusion from this whole statistical analysis was like the dollar is actually already losing its safe havens characteristic. Like in periods of uncertainty, the dollar is not going up, it's going down, right? It's like
So
an
people are
emerging market
really
currency.
people really losing confidence in the dollar and
Yes, people are losing, and I'd say it started with Trump's election in November last year. And since then, we've seen this kind of inverse pattern with increasing uncertainty. The dollar has been going down, not up, right?
Yeah, maybe the second part, real quick, about the really big miss, the revised data on the labor market. Maybe you can talk
Yes.
about.
So there's so many discrepancies in labor market data. I don't know where to start actually.
They said it was a black swan event, like a 3 standard deviation miss.
Exactly. Yeah, I think one of the chief U.S. economists, Anna Wong, at Bloomberg, she called it the black swan event because it was like a 3 standard deviation revision, right, over the past 2 months.
Yeah.
They had like close to 250,000 jobs revised in the past 2 months alone, right, in June and May, which is the second highest revision after COVID and the highest revision since the late 1960s. So yeah, it's definitely black swan event. And usually these kind of downward revisions, they don't happen outside of recessions, right? It's very rare to see these kind of employment revisions outside of recessions, which is why I think it's quite likely that we are in a recession right now or sliding into recession. But I'd say the US economy is probably in a recession since Q2. And there's so many other data that actually point towards this. I mean, the employment to population ratio has plummeted, right? It's been going down. U3 has been creeping up, like the standard unemployment rate has been creeping up. The SAM rule has been untriggered again,
Yeah.
right? But when people said like, oh, no, it's been untriggered, it's not a false signal.
Yeah.
But right, it had been triggered, which is a clear recession signal.
Yeah, it was triggered in the last summer, right? It was
already triggered in last summer. Then it has stabilized, has gone down a bit, but now has creeped up again, right?
Yeah.
So, yeah, but I think there's so many different labor market indicators, like construction payrolls, which tends to be a leading indicator for overall payrolls, right? Has ticked down over the past 2 months already, and many others like the spike in job cut announcements with the tariffs and tariffs uncertainty. So I think like the employment figures, especially in July, I think the July revision will be very important. It will be released at the beginning of September, so before the FOMC meeting. And I think there's a big chance that there will be a negative revision again to the July data. And that should actually lead to a very likely case for a rate cut in September, right? And I don't think it's so much important that the Fed actually continues its rate cutting path. I think it's even more important what Fed funds futures traders will do, right? So let's say the Fed will cut rates in September. Like the futures traders, they won't say like, oh, it's probably another 25 basis point cut in December. They will probably start to price in even more cuts. Right?
Yeah, the market is forward looking, so
it's forward looking,
yeah,
right? Because suddenly, okay, the Fed continued its rate cutting cycle. We're starting to price in more rate cuts, right? And this is like my base case. And the moment you see this, even with like only 25 basis point rate cut, like Bitcoin will start to rally again because like there's so much like steepening in the curve. There will be more steepening, which by the way tends to be a good high frequency indicator for global money supply, US money supply growth. So with further Fed easing, rate cuts, you'll see a further re-steepening of the yield curve. So higher money supply growth, which is already accelerating, right? US money supply growth is already accelerating. You've seen these bullet charts for global money supply that already indicate like 140,000 for Bitcoin, right? Over the next 3 months. So that will rise even further, right? And so I think like the bullish case for Bitcoin remains intact at least until the end of the year. I don't think we'll see a cycle top in 2025.
Okay.
And one last question from my side also, because we are approaching 1 hour. First, thanks a lot for all this interesting insight, Andrè. On institutional adoption, we have seen now there is some interest, but for many still too risky, Bitcoin. No one wants to be in the first row, but also no one wants to be in the last row. And do you think there will be a point next year, in 2 years, due to a Bitcoin special price or a special event where there will be a Bitcoin rush also from institutional adoption, where also those who were skeptics, they will run to have a 2 or 3, 5% allocation in Bitcoin?
I think we've already approached that point where like it used to be career risk to invest into Bitcoin. Like if you were fund managers like 2-3 years ago and you said like I want to allocate to Bitcoin because I read something interesting, then probably your CIO will say something, no, we can't touch it, it's for criminals, blah blah, right? It used to be career risk, right? But now I think we've passed the point, and we're seeing this internally as well with all the inquiries. We're past the point where it's like it's becoming increasingly career risk not to invest because of client requests. Clients they're asking specifically, especially millennials, they're asking specifically, are you including Bitcoin? Are you including even crypto assets in general? Are you including this into your like portfolio allocation? If not, maybe I should go to another bank, right? Why are you not recommending this, right? So it's becoming increasingly a career risk not to invest, right? And we're seeing this in a way that clients, especially like institutional clients, it used to be the case that we had to push, like it was like some kind of push effect from ourselves. So sorry, a pull effect. We told like our clients, look, this is interesting. You should consider portfolio allocation because it increases your Sharpe ratio. It's like a new kind of safe haven asset, yada, 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 right? So we had to push them and but now it's more like they're approaching us. Right?
And it will
They're
happen
approaching
more and
us.
more. Like
Yes, and it's increasing, right? So this is increasing. And I think there were two moments like over the past 2 years that actually defined this. One was like the BlackRock ETF and Fidelity ETF launch, US spot Bitcoin ETF launch. There was definitely a moment before that and after that because we did client meetings before this and after this with institutional clients. And after this, it was like, oh, like, BlackRock, they've launched their ETF. Oh, we have to do something. It sounds stupid, but it's like, it's social proof, right?
yes,
And it's like a domino effect, right? It's like the BlackRock is actually legitimizing the case for like a sovereign wealth fund, right? And the sovereign wealth fund is actually legitimizing the investment case for the central bank, right? Because they're working closely together. Like suddenly, maybe they go to the same restaurant and say like, you guys have invested in Bitcoin. Yeah, we've outperformed every other guy on the street. Like, you should also invest. Yeah, but we can't, blah, blah. That's like this kind of domino effect. It will keep going on. And you've already seen central banks thinking about investing, like the Czech National Bank, right, and so on. So we're in this kind of stage where even central banks are considering to invest. And I can tell you from like our internal experience, we definitely have like all kinds of institutional investors, pension funds already, private banks, large asset managers that are either considering to invest or already investing, right? So yeah, it's increasingly becoming a career risk not to invest.
good trend. And we also see a softening of the adversarial point on Bitcoin. As you said, 2-3 years ago, they will say cannot touch, used by criminals, topic closed. Now everyone
Yes.
who is saying no, is saying maybe it's too volatile. That is another discussion, or it doesn't fit in my investment profile, for example. It's a different argument against Bitcoin versus it's used by criminal. It has no intrinsic value, or is above all.
Yes, and this will change, right? It has been changing since the past 10 plus years, because like the volatility has gone down. It's now below equities. The profile has changed, like the risk profile during downside moves. Bitcoin has even gone up, right? Doing equity downside moves. So like the character of Bitcoin is changing. And I think this kind of change in like volatility profile will also like change investor perception all the time. And it's like a positive flywheel because, for instance, like if you consider min variance portfolios or you consider risk parity portfolios, so many institutional investors, they don't invest like based on 60-40, right? 60% equities and 40% bonds. They optimize portfolios. They use like statistical models. And one of these major models, min variance, another is so minimum volatility, minimize the volatility of the portfolio. Another is like risk parity, right? And the moment you have a decline in Bitcoin's volatility, like based on this model, by design, you get increasing allocations.
Yes.
So it's like a positive flywheel. So, and increasing allocation means more adoption of Bitcoin, which tends to dampen volatility even more, right? So it's like a positive flywheel. I call it like the allocation flywheel, essentially. It's like a multi-asset allocation flywheel. And yeah, I think that will also change, right?
Yeah, thanks. Any other last questions from Francesco or Johan?
I think I'm done. It was interesting really to understand the correlation with gold, the traditional system, the market of Bitcoin as the ultimate destination where we are all going, I would say. So yes, it's happening. Thanks to have explained to us and to our audience that it's actually happening. I mean, not because of Bitcoin price, but the shift in the traditional finance.
Yes.
Yes, thank you, Andrè, for coming on. And read his book. I would recommend it, Exponential Gold. Thank you. And yes, great to hear also that it's not improbable that we might reach 200K at the end of the year. And I also had a question, but you already answered it, that I don't want to put words in your mouth, but you're expecting that the cycle will continue through 2026.
Yes, exactly.
Right?
That's exactly right. I don't think that like we'll see this kind of halving pattern. I think like the 4-year cycle is actually dead, or at least like the diminishing returns hypothesis is dead, because what we've seen for the first time since essentially 2024 is that like the demand factor is actually outsizing the supply factor. So the effect, the supply deficit induced by the halving, which is around 164,000 Bitcoins per year, was actually overshadowed by this huge institutional demand by ETPs and also lately by Bitcoin treasury companies. I mean, like institutional demand has already outsized new supply by a factor of 5.6 times this year, right? And because I think because of this disbalance between demand factors and supply factors, and because like these demand factors are not influenced by the halving, but by like macroeconomic factors, monetary policy, and so on. I think, and yeah, where are we in the cycle? Where are we in the macro cycle? Probably close to the bottom, right? Because like we had this tariff uncertainty in April. Like the Fed is probably going to cut interest rates even further, right? I'd say we're probably at the beginning of a new macro cycle rather than at the end, right? And so all these demand factors will become even more bullish, which is somewhat crazy, but that's actually my base case.
Yeah, I thought I couldn't get bullisher, but I just did.
I agree also with the analysis. The only thing that makes me a bit skeptical is we thought also in 2021 that we had this super cycle. Everyone was convinced that we would have reached 100K, but this is from the past. But I agree. Also, we have seen a new all-time high before the halving, never happened. Generally,
Exactly,
in
yeah.
summer was always quiet. Bitcoin like always down from all-time high, and now we are having all-time high in summer. So on top of it,
Exactly, and that's probably the explanation, right? Why did we saw all-time highs before the halving?
yes,
Right? We have never seen this, and the explanation is we had this huge increase in demand, right, via ETFs, essentially. So it's
Yes.
not like it's more like a demand shock, like many people say, like, oh, supply shock, right? That's actually demand shock.
one shot.
Right?
Yes, yeah, true. Well,
Yeah,
then,
if in price terms can still go up for a prolonged amount of time and reach 500K or in 2026 or whatever, but there will not be those shocks as before. The last thing we should test will be in November, December, when usually after 18 months a supply shock happens. That we see if retail comes. If retail comes, I give a chance also to see there some gap driven by retail. But I also think, like you, that now is there is access, and by thereby there will be prolonged tracking of the bull market also in Bitcoin.
at the moment, retails are very quiet. It's been the quietest all-time high ever. Like now, 120K is kind of boring. Yes.
Yes, that's
Very
true.
interesting. Then thanks again, Andrè, for the
Thank you.
podcast. It was really interesting insights. Thanks also, Johan and Francesco, for co-hosting this event. And for all our listeners, see you in 1 week. Bye.
Yes.
Goodbye.
Thank you
Bye-bye.
very much.
Guys.
Bye. See you.